Why are some open banking payments in the US guaranteed and others not? Let's start by looking at how open banking payments are processed in the US. There is no payment initiation process whereby an API allows a consumer to push a payment in the US. Instead, payments are processed by open banking providers gathering the account details and then pulling an ACH payment. With ACH payments, there's a time gap. And so a consumer may initiate a payment through their open banking provider with an ACH in the morning, but may not have enough money in the evening when the ACH is actually cleared. This is a big risk. And so open banking providers typically offer two services: an unguaranteed product, whereby if there's not sufficient funds in the consumer's account at the end of the day, the merchant doesn't receive the payments, or a risk-based guaranteed product. Open banking providers then estimate whether or not that consumer will have sufficient funds. If they do, they will approve the payment. If they think there's a risk that they won't, of course, the payment will be declined. Now, this means that the guaranteed payment has some risk, and where there's risk, there is risk-based pricing. And so guaranteed open banking payments in the US are typically more expensive than unguaranteed. Which is the right one to use? Well, it really depends on the circumstance of the merchant. And actually, in some cases, a merchant may be very confident of settlement of funds. In other cases, a merchant will need to have funds immediately, and therefore guaranteed is a much superior product. Thank you very much for listening. My name's Kieran O'Malley.